We're unpacking a pretty profound shift in our economy. We're going to dive deep into the transition from productive industrial capital to modern rentier extraction. The source material we're looking at today is absolutely fascinating, and if you've ever wondered how the underlying mechanics of our economy actually operate day to day, well, you're definitely in the right place. Let's just start with a really provocative question from our sources. Why does it feel like you're endlessly paying just for the right to exist? Seriously, think about the modern cost of living crisis. It feels like every single aspect of life comes with a subscription fee, a premium, or another rent hike. The text we're analyzing today argues that, actually, this isn't an accident. It's not some temporary glitch in the matrix. It is the result of a very deliberate structural transformation in how wealth is generated, or I should say, extracted, in our society.
Here's how we're going to break it all down today. 1. The return of the rentier. 2. Ancient temples to modern debt. 3. Insurance commodifying your risk. 4. Real estate enclosing the commons. 5. F.I.R.E, a unified extraction engine. And finally 6. From fraud to force.
Let's get right into part 1, the return of the rentier, from production to predation.
So for a long time, the dominant narrative of capitalism was all about production, right? Building factories, investing in machinery, innovating, making actual physical goods. But according to the source material, over the 20th century, that fundamentally shifted. Capital realized it didn't actually need to build anything to generate massive returns. Instead, modern rentier capital basically acts like a giant toll booth. It just positions itself right between you and your basic necessities. Profit is no longer tied to productivity or making things, it's tied to owning access and controlling the bottlenecks.
Just think about your bank, your health insurance provider, and your landlord for a second. This brings us right to the core concept of today's explainer. F.I.R.E. It's an acronym for finance, insurance, and real estate. And the text identifies this not as 3 separate, isolated sectors, but as a completely unified extraction regime. It's a system where wealth is accumulated just by owning claims over time, space, and uncertainty. So profit gets tied not to innovation, but to literally monopolizing the prerequisites of life. Moving right along to part 2, ancient temples to modern debt. The ownership of time. Tracing back 5,000 years, the text reveals this really surprising historical thread. Finance has actually always been a mechanism for claiming future labor in advance. It's wild how the author connects these eras. Like, the earliest credit systems weren't in these free, competitive markets we picture today. They were invented in ancient Mesopotamian temples and palaces just to provision armies and bind populations. Then, jump to 15th century places like Florence and Venice, where merchant capitalism detached loans from physical goods, turning them into abstract claims. And today, modern financial markets take that to the absolute extreme, converting our future risks and expectations into tradable assets. To put it plainly, the text argues that modern finance operates as a sort of temporal enclosure. You know how a fence encloses physical land? Well, finance encloses time. It binds your future labor to service present debts. Think about a 30-year mortgage or a massive student loan. You are essentially pre-appropriating your own future human effort to pay off those who already control the present.
All right, part 3, insurance, commodifying your risk, pricing risk, governing life.
If we look at the source's historical analysis here, it shows how insurance has consistently separated people into 2 distinct groups, those who are protected and those who are exposed. During the maritime expansion of early modern Europe, merchants and financiers insured their cargo, completely insulating themselves from any financial loss. Meanwhile, the actual sailors out there on the dangerous waters, they bore the true material risks of death and injury. And the text argues that this exact dynamic is still playing out today. Elite corporations externalize their risks, while precarious individuals and households are left to just shoulder the burden. The author makes a really crucial and, honestly, kind of unsettling argument here. Insurance doesn't actually make the world safer. It just decides who gets hurt. So your rising health insurance premiums or getting a sudden denial of coverage for a medical procedure, the source argues those aren't market accidents. They are deliberate tools for allocating vulnerability downward. Vulnerability itself becomes something you are taxed on, while capital just buys protection. Let's shift gears to part 4, real estate, enclosing the commons, the privatization of existence. The text introduces this really critical definition of an asset. Normally, we just think of an asset as, something valuable you own, but the source frames it as a legal designation that is actively enforced by the state. And what does that designation actually do? Well, it sanitizes the origin of the wealth. Historically, land was enclosed violently. Common lands were seized, from the Norman Domesday Book right up to early modern enclosure acts, which pushed subsistence communities into wage dependence. Calling it an asset totally cleanses that violent history, converting a human necessity, like housing, into a neat, clean, balance sheet revenue stream. And the source makes this absolutely fascinating historical contrast. Like, what is the actual difference between modern fire structures and historical feudal rent? Well, in feudal times, a lord literally used a sword and overt coercion to collect rent openly. You knew exactly who was extracting from you. Today, the extraction is identical in its outcome, but it's collected indirectly. It's hidden behind highly sophisticated legal abstractions, sanitized contracts, mortgage-backed securities, and debt. Ultimately, the source argues that modern rentier capitalism operates essentially as feudalism, just with way better paperwork. Because housing is a biological and social necessity, you can't exactly just opt out of it, right? And because of that, real estate markets effectively govern labor. Think about it. High housing costs absolutely suppress your mobility. If you're weighed down by exorbitant rent or a massive mortgage, you are tightly tethered to your job, even if the conditions are terrible. Property thus becomes an instrument of social control, enforced simply by the price tag of shelter. Which brings us to part 5, FIRE, a unified extraction engine, a system of dependency. According to the text, FIRE isn't just 3 separate, independent industries out doing their own thing. They are mutually reinforcing components. Finance gives you the leverage and credit to buy the property. Insurance steps in to shield the elite capital from the risk of that property being destroyed. And real estate itself guarantees steady, reliable cash flow drawn straight from the wages of everyday people. Put it all together, and it is one giant, coordinated toll booth on human survival. The mature form of economic extraction today basically operates in this specific sequence. Step 1, you control a bottleneck of basic necessity. Step 2, you securitize it. You chop that necessity up into fractional, tradable legal claims that can be bought and sold by anonymous investors halfway across the globe. And step 3, you extract rent continuously. As the text outlines, this system transforms domination into investment and theft into yield, without actually producing any new value for society whatsoever. Okay, our final section, part 6, from fraud to force, FIRE as a unified regime of control. The text argues that the whole myth of the free market basically dies right here. We're always told that markets discipline powerful corporations through competition, right? But under FIRE capitalism, financial institutions become too big to fail. Insurers socialize their catastrophes onto the taxpayers, and real estate conglomerates consolidate entire neighborhoods. The market no longer disciplines capital. Instead, capital disciplines populations. Economic failure is continuously pushed downward onto everyday people, while success is heavily insulated upward for those elite institutions. This leads to what is probably the source's most severe conclusion. Eventually, the abstraction has its limits. When people can literally no longer afford the toll booth, when they default on their debts or just can't pay their rent, the system has to shed its market mask. It can't pretend this is just a voluntary contract anymore. To ensure the rent is paid and the assets are protected, the economic system has to rely on state force. Sheriffs, courts, evictions. Force becomes the final guarantor of rent. So, I want to leave you with this final provocative thought from our explainer today. If the very basics of our survival, our time, our shelter, our security, have all been transformed into securitized assets owned by a distant rentier class, who actually controls the economy? And more importantly, who controls our lives? Next time you pay a bill, a premium, or your monthly rent, keep these concepts in mind as you look at the structures around you. Thanks for joining me on this explainer, and I'll catch you next time.